This is the Financial Coconut Podcast, Singapore's first personal finance podcast network. My name is Rakesh, and together with Anthony, we discover worthy financial news and derive insights for all you coconuts. We are part-time investors with an intense full-time career. If we can do it, you can too. So join us every Thursday for TFC Weekly Market Updates. Hey coconuts! Welcome to another weekly episode where we scour the net to find worthy financial news for you. This week, earnings season has ended, but we have 3 stories to take a back seat, reflect, and really focus on some sort of strategy. So the first story is whether a new bull market has started. Technically, 20% increase is a bull market, but does it actually mean a bull market like we all know? We dissect that through the S&P. Next, a bit of a banter between Anthony and I on Netflix crackdown on sharing passwords. Is this a good thing for shareholders? Is this a bad thing for Netflix? How's the content going? We talk about that all together with a little bit of a rant. Hopefully you like that one. And last but not least, should we actually invest into China? It's got a weak recovery, turning off foreign investors because they could make more money in the US market. So we're going to dissect that a little more and talk whether we should actually go into the market in China. All this and more on this episode. So let's get to it. Hello, coconuts. Welcome to another weekly market updates with me, Rakesh.
And Anthony, and we are at the end of earnings season, I think. I think for the first time in a few months, we don't actually have much earnings to talk about, which is, I'm always a bit, it mixed feelings about this because, it's always a bit tough, but, it's good to talk about other things, I guess.
Yeah, it is. I think maybe we can take a step back from all the, gem. Like we were literally every week we had some sort of earnings, right?
Yeah, and like all the numbers and all that, and just maybe focus a bit more on strategy and a bit more on like kind of interesting things that are happening that deal with the business and not necessarily just numbers.
Yeah, absolutely. And it might even help us with predicting and kind of figuring out which one to go for before
fundamental analysis, right?
Yes, absolutely. Yeah, absolutely. All right, and for that, actually, that's a good segue into the 3 topics we're going to be speaking about. Number 1, has the bull market started, right, in the US? And we're going to talk a little bit about that with regards to Wall Street, right? Is it definitely going up? What's really meaning all of that? We're moving on to our second topic, which is Netflix. Less on the earnings call, more on the cracking down of password sharing, as they call it. We're going to definitely dive down. I'm sure most of our coconuts here have been affected. If not,
oh my God, I have a rant for that.
Oh my God, I have a rant for that. Okay.
It's bloody terrible.
And number 3 is China's weak recovery. Is it turning off investors? Right? And where are they putting their money if they're not going into China? So 3 pretty interesting topics. We're going to kick things off with number 1. Anthony, bull market started already.
Well, I mean, it really, really depends on how you define it, right? But maybe just the interesting bits. Typically people call bear market 20% off the highs and a bull market 20% off the lows, right? So just by that, very basic threshold. Yeah, we're in a
very broad definition.
Super broad definition. That's like a clear red line. No nuance, nothing. 20% up means bull. Yes, we are in a bull market, right? We are more than 20% up from the closing low of 12 October on the S&P. And for the Nasdaq, we are way past that. We are like 30 something percent now. Right, so but S&P is broad market, So we take S&P. We are in a bull market technically, but this is not really a scientific definition by any way it means, right? It's just 20% down is bear, 20% up is bull. That's all.
Right. Okay. We did see some sort of a rally last year as well, and then there was a dip immediately after that, wasn't it?
Yeah. So I mean, last year we had a few rallies, which we very nicely called bear market rallies instead of new bull markets. Partially because they didn't hit 20%. So I think the biggest one was June to September last year. It was like 15+%. Interestingly, the rally topped out at about this 4,200 plus 4,300 level at the S&P. So and then there was some news. Nobody remembers what now because it's just news, and then it went back down all the way to hit the October lows very quickly, right? Within like a month, it went down 20%. something like
Right.
that. So that was June to September, October. Typically in every cycle, like there's overarching themes, right? There's a general trend where it's a bull or a bear, and counter cyclical trends within that larger trend is called, well, in this case, bear market rallies. So I guess the immediate question now is whether this rally is a bear market rally, or is it just the rally that
Or an
starts the new
actual
bull
bull.
market? Yeah, the starts the new
Yeah.
long-term bull market.
And actually, we're now sitting at what, 4.3, right? At the S&P, 4,300,
I
around that
think
range as well.
so. I haven't actually managed to open my Tiger today.
Right.
Yeah, we're at 4310.
There you
Despite the
go,
market
right? Just
opening, and that shows how busy I've been. I haven't actually opened my Tiger today. Yeah, we're at 4310. So very close to, actually slightly above the last high in September, if I'm not wrong. Oh no, slightly below. The last high was 4325. So we are just below that.
got it. But I mean, take us through, right? I mean, obviously the index would go up, and most of the bigger players are the ones actually driving this index up, like Apple, for example, and a few other companies. Have we seen this across the board with regards to all the companies actually going up by 15-20%, or is there some sort of a skew in the matter?
There is quite clearly a skew. Of this 20 odd percent, I think the top 7 account for like 15% of the returns.
Oh wow!
So
But these
like,
are
yeah,
what?
3/4 of the 20%, right? 15% of the index. So these are like your Apple, Nvidia, Microsoft. The other A, can't remember what it is offhand. But yeah, I mean the broad idea is that of the 500, that make up S&P, vast majority of the positive returns this year have been driven by the big tech stocks, right? And
Isn't the other A Alphabet, by the way?
oh yes, you're right. Just slow today, right? That's on me. Yeah. So I can't remember acronyms now. But I mean that's besides the point, right? So you kind of have this 7 stocks driving vast majority
Yeah.
of the returns, and you have the other 493, which is bloody a lot of companies, just kind of treading water and maybe being a bit positive, right? So I mean, and that begs the question, right? Like, how do you determine, or what is a long-term bull market trend? And you would think quite intuitively that a long-term bull market trend is when all the companies broadly participate, right? Because it's a
Absolutely.
positive economy, the economy is booming, everybody's very happy. So we are past the worst, and that is when the long-term bull starts. So if that is going to be a necessary condition for long-term bull, then well, this isn't it lah. I mean, it could possibly still become it, right? We really need to see that proven out before we can actually make that statement, I would say.
Yeah, and I mean, with regards to the tech companies as well, didn't like half of them lay off, which then reduced their bottom line, and then now having the same sort of revenue. So therefore, they said, okay, lay off, and then usually from a layoff, they will see a spike in terms of stock growth as well, right?
That's by the by, right? And as sad as layoffs being by the by is, I think that's one of those cases in this situation where it really was a cost cutting exercise to get to higher profitability, right? Whether it was a justified and necessary cost cutting because people overhired, or whether in some cases it was really just opportunistic. I just want to fire people and make more profit and squeeze my labor force harder, right? Even though I'm super profitable, like Microsoft. But
I know I say one.
I say one, but yeah. Anyway, so I think either way, we and especially this past earnings season, we actually saw earnings do well, right? I think the majority of companies actually beat expectations. Slightly lower expectations because everybody expect recession, whatever. But they beat expectations. They are performing on a company level better than expected, right? So in a sense, the index going up isn't necessarily a bad thing, and yeah, it isn't necessarily unexpected. So might be good, but we shall see. Right? Earnings have been holding up so well, so far so good.
It is, but okay. So this for me is a little bit of a statement, right? Is it a spin, right? Done by the companies? Obviously, they would reduce expectation settings, etc., since late last year. Therefore, and on top of that, they have been opportunistic, or they've pivoted, whichever way companies have said it, to then cut your bottom line and then obviously be above expectation with regards to profitability and earnings per share and so on and so forth. So for me, that seems a little cooked more than the fact that the market is growing or they actually have more demand and so on and so forth. Would you agree? Disagree?
But I mean, numbers are numbers, right? So they managed expectations down certainly, but they are still showing positive growth, right? Vast majority of these companies, especially in the tech space, were still showing positive growth. It's just that, like, for things like Snowflake, they last quarter or 2 quarters back, they adjusted, expected growth from 60% to 45%, right? And said, well, we are kind of reducing growth because we are reducing sales and marketing. We want to, become profitable. So, I mean, sure, they managed expectations down to 40, and then they slightly beat by getting to 42%. So fine, that's a bit of spin, but at the end of the day, it's still 42%, right? It's still growing, kind of sequential. It's still growing year on year. A lot of them are still growing sequentially from last quarter. So, that, I mean, think back to 6 months ago, we were all kind of thinking of a third quarter, fourth quarter recession. This is not supposed to happen, right?
Yeah.
If the recession really was coming, you should see growth slow down by quite a bit more. So, it is still, I mean, notwithstanding any spin, it's still kind of a positive thing, I would say.
Got it. And I guess where I'm coming at, I mean, being the front line in a company as well, the sentiments I'm getting is the fact that everybody's still very cautious. They still don't want to spend, right? They, like every company that I'm speaking to, including my own, is very cautious on the every dollar that they spend. So even though they have had all of this, they're still very, very cautious of something that could happen in the near future. Now, as coconuts, we are looking to invest. And if we're hearing this on this side, how would you say is a good idea or is a good thinking methodology on should we invest because we think there's a bull coming in? Or should we wait and see, right? Without feeling some sort of a FOMO.
If it asks me, right, I'll always ask you to just invest. Just buy. Now, don't care, just buy, right? I mean, that's been kind of the prevailing sentiment, for the last 18 months we've been doing this. Down, that might means you can buy more. Up means good momentum, we buy again, right? I am supremely optimistic about markets, which is why I always think you should buy. But I mean, and I think that kind of leads back to, I mean, but leaving that aside, you kind of have to think about, well, where the market is now, right? And you talked a bit about, well, there's a lot of uncertainty in business planning and all that. I think everybody kind of agrees with that. People still think a recession will happen. We are not out of the woods yet, because the Fed has hiked and hiked and hiked and nothing has broken. Traditionally, inflation hasn't really come down unless there's been a recession that's been induced. So, has a recession happened? I mean, there was a technical recession last year. Nobody serious actually thinks there was a recession. So, no, right? We still see a really strong, even if slightly weakening labor market. There has been some bank crisis, but that has been quite self-contained because of liquidity issues. So, at the end of the day, things are breaking at the edges. The actual economy hasn't broken that much. So there is room to go, right? And I think that is kind of the central thesis that supports a recession coming up and a bit of a conservative view, in the next 6 months to a year. But that being said, equity markets still keep going up, right? And I think that there's a bit of a divergence there, because it used to be maybe a month or two back, you could see equity markets going up and bond markets kind of saying, there's going to be rate cuts by the end of this year because the Fed will have induced a recession and they'll cut rates, and we are near the end. That, I mean, from the Fed rhetoric over the past few weeks, that has actually reversed, right? The expectation for cuts has actually been removed, and now the best to hope for is a pause and maybe even an increase in the next round, if not this round. Right? So, there is now again a bit of a divergence between what the bond markets are seeing, which is more tightening, right? And what the equity markets are saying, which is, there should be a soft landing, and therefore we can still go up, right? So and because of that divergence, I would still say be cautious. But being cautious doesn't mean you sell everything and you go to 100% cash, right? Being cautious still at most means, this month I supposed to DCA, I lazy a bit, I wait for next month or next quarter, I hold a bit more cash, or I DCA only half. That sort of thing, right? So you should, FOMO, of course there's FOMO. I mean, do you have FOMO for not buying Nvidia?
Of course.
I
have FOMO
bought
for not buying in January.
Yeah, and I have FOMO. I bought it, and I still have FOMO for not buying enough, right? So of course, once there's momentum, there's FOMO, and that leads to more momentum, right? But you kind of always have to be able to take a breath, take a step back. Well, the markets do look a bit overpriced, a bit
Dicey.
overbought, then maybe I want to, be a bit tactical, right? I hold a bit more cash for now. I don't DCA as quickly the next round. I time the market a bit, right? A bit, not a lot, because you're never 100% certain, right?
And we
So
will never time the market. We're not movers.
or you time the market, but you don't time it with 100% of portfolio, right? Because like that's kind of insane. Unless the portfolio is $2,000, then fine, go ahead. You should time the market with actually no, you shouldn't be in the market. You should just like buy options. But
Yes.
then that's the way to think about it, lah.
Got it. Okay, awesome. And I presume as a plug here, these are some things that you will teach in your course.
Yes and no. So I mean, I don't think we will teach technical analysis because it's still largely bullcrap. But of course, we'll teach quite a bit about like portfolio construction, how to manage your risk, and all of that. And part of that approach necessarily is a bit of market timing. Yeah.
Absolutely. Awesome, folks. So if you feel FOMO, you know what to do, lah.
Yeah, bye.
Yeah.
I mean, buy the correct things, right? But buy.
Awesome. I'm actually a bit FOMO. I didn't buy Amazon way back in I think it was December when it dropped.
Yeah.
That my biggest FOMO.
On that note, Netflix was something that I've kind of wanted to hold for a bit and just never got around to because lazy log in. And then it went up and up and up, and then like,
and it's still going. It's still
going. And then that's the problem with all these things, right? They go up, and then you feel like I shouldn't chase.
Yeah.
And then the time you chase is the time it crashes.
Absolutely. All right, and actually, that's a good segue. On that note, we're here to
I'm
talk
brilliant at this today.
Netflix. Absolutely. Maybe the acronyms are not your thing, but the linking not bad, lah.
Linking not bad.
Awesome. So Netflix Crackdown. Hey, Anthony, you subscribe to Netflix with other people?
My wife does, and to me, it's not with other people, right? So so my story is we subscribe for I think 2 screens.
Okay.
So anybody can use those 2 screens. But we let my in-laws have the login details as well. I mean, they stay obviously in a different place. But to us, it feels like, hey, we subscribe to 2 screens. We literally have 2 people watching it, either us or my in-laws, and then we're kind of the same household, lah. I mean, like we are family, right? It's not one of those cases where I lend to you, for example, right? Where we are close like family, but no lah, not really.
Hey, you don't, huh? But anyway, coming back to it, that's exactly what it is, right? And I've been sharing with my parents and all of that as well. But lately, I've been hit by the crackdown because we live in 2 different addresses.
Yeah.
And so while I can still technically watch it on my phone, I can't watch it on my telly.
Yep.
Okay. And that's roughly what Netflix has been doing. They sent a message out. Was it at the start of the year or late last year, if I'm not mistaken? And I think we touched on it in our last earnings call.
Yeah, I mean, they've been announcing it for a bit. They launched it first, I think, in New Zealand early this year, and then it finally spread to the rest of the world last few weeks. Yeah.
And here's the I mean, obviously Netflix were going through some issues and they needed to find money somewhere, right? Let's be honest. And the statistics that they've come out was shocking. For example, back then they estimated more than 100 million households, which is about 43% of their user base, actually share the accounts, which means it's money technically they could tap into. 100 million households.
Yeah.
That's insane amount, no?
Yeah, but I mean, look, this is history, right? Because when they first launched and they were trying to get users, and they even had a tweet about this, they said, sending love for this Valentine's Day is sharing your Netflix password. So it's something that they actively encouraged 6-7 years back, I think. Can't remember the exact year, but it is something that they actually encouraged when they wanted to get more users, and then now they go, oh, actually, you know what? Wait a minute, we can't. So we need more money, we need more signups. Therefore, we're going to stop this, right? I mean, I blame the Fed. Of course, everything blame the Fed. So I blame the Fed. I don't blame Reed Hastings. But it's terrible.
And now they've changed their little slogan, haven't they?
Yeah, of course. I mean, they're trying to crack down on this, right? So
their slogan is changed to share your password with everybody in your household with love.
Yeah, I mean, I think of my in-laws as real family, and my household. I give them allowance too. That includes my Netflix, right? So, like, I mean, look, I have a lot of sympathy if they said, yeah, like don't share amongst friends or share only amongst like select group of people. But to me, it's like, look, you place a limitation on me that I can only watch on two screens, right? So that just means that two people can watch at the same time. It could be my wife and I, and not my in-laws. It could be my in-laws and my wife and stuff like that.
Yeah.
So I still have those two screens, but I use it through one IP address or two IP address. Sirs, what does it change? It doesn't change anything, right?
Irrelevant. Exactly.
Yeah. So I mean, this is to me purely a cash grab. Good
Absolutely.
for shareholders, of which I am unfortunately not one, but
Yes.
bad for users, I would say.
And actually, on that note, let's take you through some of what might cost you if you are sharing with other people, your friends, or even someone in a different household if you're getting wet, right?
So sorry, this is my privilege. I don't actually know what the amount is.
Right. So Netflix has said that you can now have people outside your home to use the same account in Netflix. So you have the base, which is I think 12, 16, 19, and then 21 or whatever it is. But you pay an additional $8 for an additional fee. And this is in the US, right? I think Singapore is about 7 Sing, something along those lines. So
hooray, we're cheaper.
But $8 extra on whatever you have had to have an additional household. But the number of screens still stay the same. So if you're doing that, technically, say $21, which is 4K and all of that, it's the highest thing. You have to plus $8 a month to get an additional household. You can have another household on top of that and you pay another $8. So really you're looking at, quite a lot of money, because nowadays, if you think about it, $21 divided by 4 people, how much is that? $5? Yeah, about $5. Plus a $7 thing, you're effectively more than doubling your monthly subscription into Netflix, right?
Yeah.
Clearly this has been calculated, run many tables and analysis and all of that. And it has actually paid off so far. So apparently there were over 100,000 daily signups end of May, 26th and 27th, according to a news source.
Sorry, so this is additional above their normal run rate?
I don't know. So this is including of their normal run rate, but I don't know how much their normal run rates are.
Okay.
But yeah, correct.
I mean, they weren't doing that many new ads.
No,
every
they were not
day,
doing 100,000.
Yeah.
Yes.
So it's still quite big.
Yes. This spike, and as we have seen continue to grow, apparently exceeds the COVID-19 lockdowns. When everybody was locked down, everybody was subscribing to Netflix. So we've definitely seen some sort of an inelastic demand where every household needs to have Netflix.
Yeah.
And on my side, for example, I have cancelled it because I cannot pay an additional amount. Yeah, I know. I mean, you guys used to make fun of me. You and Jefferson used to make fun of me as the guy that had all the subscriptions, right? Remember?
Yeah.
Back in the day. And I'm like,
back in the
day. And now I'm like, you know what? For like $15 a month or $14 a month or whatever it is I have to pay, or $12 a month, is it really worth it? Or should I get HBO? Or should I get Paramount Plus? Now it's put that question into me as well. But clearly I'm not the norm.
Yeah.
But as for, coming back on point, besides my ranting of why Netflix doubling it, as an investor and as coconuts are looking to invest into Netflix, which clearly a bit of FOMO on you and me, do you see an avenue here that the next earnings call is going to be amazing?
This is tough, right? So I just Googled this literally. And I think where Antenna, which is the news source you're referring to, they kind of took the May 26th and May 27th dates because that was the date that Netflix actually did the crackdown and encouraged everybody to sign up. And 100K seems like a bit, but as of last quarter, Netflix had 74 million subscribers in the US and Canada alone. So 100K is like not even 1%, right? It's like 0.1%. No, 0.15%, something like that. So it's not a huge amount. I mean, times 2 because it's or even times 5. Okay, fine. You might get to 1% somehow, right? But it's not great subscriber growth, I would say. It is definitely incremental. It's incremental on the margin, it's incremental on revenue, but it's not that big driver, I would say, of their revenue for the next quarter, right? So one, that's one. Two is, I think and maybe this is where we differ, right? You kind of say, oh yeah, it's a bit more expensive. I don't want to pay for this anymore. I look at other competition. I think my calculations, well, or my wife's calculation, because I did not even know the price, right? My wife's calculations, oh yeah, it's $8 a month, right? The only thing that would stop us is really that there were no new shows coming out that we wanted to watch, and that's increasingly the case. We are kind of running out of things to watch. In which case, it might be at the time to cancel it for 6 months or so, switch to something else, and then watch that something else for 6 months. Although we have pretty much all those other something else's.
Yeah, absolutely, right. And that's my point. For me, Netflix has been dwindling a little bit, with the exception of maybe Drive to Survive. But even I didn't fully like this season.
That's because you don't watch K-drama.
To season 1, yeah, I don't. I watch reruns of TV shows, which I clearly have in my hard drive. So, or I subscribe to Disney. That is effectively where I am. For me personally, and I'm clearly not the norm, because people like, for yourself, Anthony, right? That's where we differ. For me, is it worth it for me? As of now, no. But will it get better? Maybe when I have a FOMO that everybody's watching the next, I don't know, what was it? Too Hot to Handle, or what was the next K-drama? Kim's Convenience, Squid Game.
Yeah. I mean, like Netflix are terrible at flagship shows, right? So it's just like, it just kind of lets to your point of not enough content or not enough good content, right? Because they haven't really launched something, even along the vein of like Big Bang Theory or Modern Family. They've tried, but I think that's just not in vogue for TV. They haven't really launched something like LOTR on Prime, Succession on HBO Go. So they have like random tentpole shows here and there, but they haven't been great at those for the amount of shows that they churn out. So maybe that's just the kind of problem with the thesis, rather than the actual pricing strategy.
Yeah, and I think it's that comparison, right? Is the value? Is that really of value to you? And I think maybe the other angle is that most kids will want it because for all the kids shows and so on and so forth, so the parents bo pian.
Oh yeah, oh my god, I've watched so much. Okay, not Coco. I've watched so much like Gabby's Dollhouse and Tayo Tayo.
There you go. You see,
lifesaver, man. I tell you. I cannot deal with my kids. Chuck them in front of a TV. We're good to go. Parenting, excellence here.
Yeah, perfect. Model parent. Model parent. All right. I think that's our little rant on Netflix, but we'd love to find out what you think. Do you think it's value for money? Please let us know in the chat. Write to us. But I think, let's see where this goes. If we do see a lot more people going into Netflix and paying that extra, the next earnings call will be great.
Yeah, no, but I mean, that's the problem, right? It's a one-off boost. It's not, it's not going to be something that continues for the foreseeable future, because you can only turn that many people, for this one, and they'll continue, right? But that's an increase in the growth rate for one quarter, which kind of levels off. You're sure you will have that as a base revenue going forward, hopefully, but it's I don't think it's going to do anything great. If I were a shareholder, I would be very hopeful on their ad supported service, which everybody is turning to, right? Like Amazon wants to do that, Disney wants to do that, or have already done that. Paramount is kind of already doing that. So I think that is the real revenue driver there, and that's where people should focus on.
Absolutely awesome. Now from the US to China.
No segue here. I just give up.
No segue lah. Yeah, no segue lah. Give up already. Why got issue? Tell us.
I mean, China, plenty of issues. I mean, lots and lots and lots of issues. But we kind of wanted to talk about this because there was a relatively interesting article by this lady called Alicia, who's he's a chief economist of APAC at Natixis, which is quasi-private bank, or they are more private bank than a commercial bank. On the FT going, oh yeah, China is just turning off to foreign investors, which I thought was interesting, and we should get her on the show one day. But I think where I see that snigger, but where it kind of got to that was interesting to me was that sure, we have talked a bit about China not having that great a macro recovery, right? We have talked, and I think that there's this problem here where China has, I mean, famously the words of JPM 2 years ago, was considered uninvestable, right?
Mm-hmm.
And that might really seem to be the case, increasingly the case for Chinese equities now, 2 years down the road, which is why we kind of it might be time to revisit this and see if there's anything to it. So I guess just to set the context, I think that there's been a few bad things about China, right? One is, first thing, macro recovery, not great. A lot of Western economies have had revenge spending. They are still continuing, right? Not even stopped. It's still continuing. Chinese naturally more kiam siap, more prudent. Never happened. Manufacturing also not really improving, partially because the US and the EU haven't been ordering as much stuff for exports, but partially also because the domestic spending hasn't recovered, right? Despite all this, no real macro stimulus, no real fiscal stimulus. They have been trying to get banks to lower their interest rates to kind of stimulate investment.
And they were trying this at the start of the year already, right? Trying to lower the rates and so on and so forth to get stuff going.
So by no real stimulus, I mean there's nothing that's actually material or substantive. It's all like, I tweak this here, tweak this there. I try to do small things. It's not like the US 50 basis point, decrease, right? Or I helicopter like $2 trillion of money to the whole economy, right? Everybody has money to spend. This is like, yeah, sure. The banks, maybe we decrease deposit rates by like 0.25%, right? We are not even decreasing our central bank rates. We are just decreasing what we tell our commercial banks to give as deposit rates, right? Which is another layer back. So you go, that's terrible. So the market itself is kind of struggling, right? And then you look at it and then go, well, if you're talking about foreign investors, they all have access to the US. The US gives you 4-5% risk-free yield. Why would you have to go to China? Even if not, as we have talked about, the US markets got FOMO, got momentum, very good drivers up. Why do I want to go to China? Which, well, I mean, maybe as of September, October last year, they kind of promised growth, and then everything died in by the time March rolled around, right? So, if you want to speculate a bit, you go to the US. If you want like longer term growth, you go to the US. If you want to look at backtested performance and say which market grows over the long term, you go to the US, because it's the only market with that 50, 60, 70 year of equity market performance, right? So
yes,
from all of these things, why would you go to China? And then you add on to that, geopolitics, and will China invade Taiwan? What's going to happen to like offshoring of all these investments? I mean, the Chinese are not helping themselves with like cracking down on BCG and all those random people. It's harder to do business in China as a foreigner. So if you're a foreign investor, why do you go there? Right? They might just take my money away.
Yeah, exactly. So why would we, right? And we've been talking about the China stocks. We've been talking about them saying it's good value, etc., etc. We just had it 2 weeks ago. So tell us a reason to go to it.
I mean, I'm kind of struggling, to be honest, right? I think there's probably 2 or 3 ways to look at it, and these are all really medium to long term, reasons, right? So the first is really that short term. I think we're all quite aware there's a lot of headwinds, right? We need to kind of figure out where the new normal is at. We are slowly getting there, but we will get there. And then once you get there, there will be that period of growth where people are happier. But I think, medium to long term, a few reasons to be bullish on China. One is still, their capital markets are relatively earlier at the stage of development. They're a bit like Singapore, right? Where people buy property, they don't like buying stocks for whatever bloody reason. I still don't get it, but boomers must be boomers. There's cultural reasons for things like this, right? So if that shifts and there's broader local participation, that can replace foreign investor flows, right? So that's fine. I think that's one. And 2, the biggest one is really, at the end of the day, no matter what happens, you talk about demographics, that kind of stuff, it's still the world's second largest economy, right? They still have 1 billion plus people that speak their own language that need to buy local. So whatever thing that you want to sell into China, you still have kind of the second largest, if not the largest market in the world to sell into. And an economy, and a population which is getting relatively richer and therefore relatively able to spend, right? Or more happy to spend and, have more disposable income, all that kind of stuff. So, if you are buying like Tencent, maybe not Alibaba, but if you're buying something like Tencent, or if you're buying into like, China retail, there is still a very big growth story there, right? Even ignoring their potential expansion into like Africa or Southeast Asia or anywhere in the world that's essentially not US and maybe not the EU, there is already a very big market for them to win and capture. So why not? And I think that's really, and I guess maybe the last reason, if we need to, is really with geopolitics, you don't know who will win, right? And you don't know how things will end up. And I think increasingly the view might be that, if you're going to have two different supply chains, then that just means that there will be profit margins on two sides, and you should be able to capture margins on both ends. Which also means that if you can buy a Chinese company, it's fine. They just service the Chinese market, and you buy the factory that has the company that has a factory in Vietnam and that supplies the rest of the world, right? So
Absolutely.
just having a Chinese company doesn't mean that it's screwed. Or just having a Chinese supply chain doesn't mean that it's screwed. It just means that there's different opportunities, and that's. And from a portfolio perspective, you might not want to be heavily weighted only to the US side, because then you are just kind of ignoring pretty much half the world, or like a third of the world.
The other superpower, right? Yeah, no, fair enough. And I think with China, this and that, we've been talking about it since
forever.
Half a year ago? Since June, right? And actually 1 year ago. You're right. Yeah, about 1 year ago. Talking about it and looking at the ways into the market. And I think even using China and as a way to divest into it, to just sort of figure out what's going on geopolitically, and the fact that everybody's having their own supply chain, where before, used to be a lot more efficient. That could definitely be a way for us to make margins into both sides.
Yeah.
Agreed. But here comes the question.
Yeah.
How much into China?
That's always the difficult part, right? I would think about this as maybe an increasingly lowly correlated asset class to US equities, right? So I think traditionally, emerging market equities and Chinese equities and US equities have kind of had a strong correlation, because what was good for US was good for the world, right? And what was bad for US was bad for the world. As the divergence or the de-risking continues, theoretically, the correlation between the markets should also decrease. And that means that, there is a chance for there to be some sort of, proper diversification between the US and China, and therefore be able to get better risk-adjusted returns, right? Because you have low or negative correlation, probably low rather than negative, because they are all still equities, but you never know. So I think, and for that sort of allocation, fine, you might still think, and I do still think, that longer term US will outperform, because that's what their capital markets are, right? Their capital markets are the way for their economy to outperform, with all the financialization. So you should still have large, allocation to the US and that type of growth. But on the other hand, you could have realistically 10-20% to China, and that wouldn't be bad.
Got it. Okay. Oh. Awesome, man.
Why are we giving away teasers for the course? Hey, that's not fair.
This is just a tease of what you will learn in our course. So sign up.
Yeah, different ways of thinking about the markets, right? It's a bit of aggravation, but there's like real proper reasons for why you should do things.
Yeah, absolutely. And thanks for taking us through that, Anthony. That was definitely enlightening. And coconuts, hopefully, we managed to shed a little bit of light into the US and the China market.
And why should buy China? Maybe not so much, but
Awesome. And with that, thank you so much, Coconuts, for listening through. This was a little bit of a long one, but hopefully we were able to talk a little bit higher level in this sense, strategy, complaining about Netflix, and of course, should we go into China? We will see you all next week. Thank you again.
See you.
Bye.
Oh, not me. I'm away next week, but yes, see you guys soon.
Yes. Bye. Thanks for tuning in to this week's episode with me, Rakesh, and trust that you learned something today. If you enjoyed the session and want to be part of the banter, join our community Telegram group or follow us on social media. We also have a weekly newsletter to get a digest of the news we covered. To sign up, please click the description below. As always, we love your feedback, so share that with us at hello@thefinancialcoconut.com. Thanks, and stay safe.